What is interesting, and I'll throw this tangent out there, where I see a lot of risk is going to be in the commercial space. And right now, vacancies are ranging between 15 to 25%. For now, with the Zoom situation, with the tech companies that are losing VC funds left and right, and that dry powder drying up, and their valuations coming down. Right now, in fact, that All In podcast was talking about San Francisco having a 40% vacancy rate by December. Those are the markets where I see absolute risk, and I wouldn't touch with a 30-foot pole.
To me, that sounds like a great buy.
Well, when it happens, but
it seems like a great buy. Long term, it seems like a great buy. San Francisco will rebound at some point. At some point, the trade swings too far. Again, it mean reverts one way or the other. I believe contrarian investing 100%, is phenomenal.
Right, but we're not even there yet.
Back to Warren Buffett.
Right, but we're not even there, right?
Everyone else is fearful, and be fearful when everyone else is greedy.
But we're at a 24% vacancy in San Francisco. We're going to double that. So 70 million square feet of space, 30 million will be vacant by December. We're at 15, 18 million right now. So those prices aren't even baked in yet. And I don't know if you've been there, but places like Walgreens, all gone. CVS, all gone. People, you think about restaurant owners and everyone else who are moving out of there. They lost 4% of the population last year. 4%.
It's a big number. It's a big number.
So those markets are the ones I see a ton of risk in, and in a space that I'm not too convinced has a lot of legs in the next 18 to 24 months.
You may be absolutely right. One of the things that you said was you mentioned dry powder drying up. I don't know if you said that. I don't know if you meant to say that, but we saw record amounts of dry powder piling up over the last 12 to 18 months in all different sorts of investments. So I actually think that dry powder number is even going higher as old investments are coming due, as funds are distributing. I don't see dry powder actually increasing and being deployed anytime soon. Money's here. By the way, I'll say this. Let me just finish this thought. I have seen where this time last year, I was probably seeing 2 or 3 deals a week, whether they were real estate centric, whether they were venture centric, whether they were growth or private equity centric, whether they were crypto centric, 2 or 3 deals a week that I was seeing. I have probably seen that number go down to 5 to 6 a month. Mm-hmm. That's on the GP side, folks looking to go out and explore. So money is not moving. Money is on the sidelines. That is a fact.
Right. That's right. Yeah. So I'm saying in the tech space for sure, the VC money is pausing. That is absolutely. If you don't have a fortress balance sheet right now and cash in the bank, I have friends in my last company. They're telling me they're reducing their cash burn by 15-20% because they're anticipating no more funding for years. It's multiples have halved in the last 6 months.
They've actually more than half.
There you go. Yeah.
I was working on a Series D 3 months ago. We started out on the valuation being in the 6s. They were telling me that this is a 40% discount to when they were having this conversation last November, where it was over $1 billion. They then came back and said, we're now at 5 and change. Then we're at 4 and change. And they ultimately settled sub 4 valuation.
Yeah.
That's a crazy drop. That drop has we've seen it across all verticals. We haven't seen it in real estate because real estate is appraised value and there's smooth returns, which, by the way, I like smooth returns. It helps protect bad behavior from people that are irrational.
I just have a graph on this around the cross correlation of other assets. Real estate's very linear, right? There are telling signs in real estate that will let you know it's happening. Now, again, we know there are some price concessions right now, but one old saying is that, if you have more than one home, the second one goes first, right? So in places that are vacation,
it depends. Where is it? Because right now, if my second house is in Colorado, I can't stand the heat.
Well, yeah, sure. Yeah. But in general, you're never going to, your kids go to a school, right? You're not going to uproot them to go to some other school, right? So they sell the second, third home first. And so you start seeing these markets like Vegas tank, or you start seeing like a Lake Tahoe start to pull back, or these markets like Miami. Those are usually the first movers. And then it gets into the more primary markets that have stable economies, right? And that takes time. I mean, even here in Austin, the first signs are usually San Antonio, right? Once that takes a hit, not as strong of an economy, kind of that blue collar workforce first, and then Austin second. And we've seen a dip in San Antonio, and we're starting to see a slight dip here in Austin. Now, where that floor is, we'll see. There's some big news coming here in Austin. I won't say what, but as
it's all over the place, man. Big chip
Samsung is
big chip bill. Yeah, this is great. It's great for Texas. We got a big chip bill passed, so that's a big deal. Those are phenomenal tailwinds to this economy, right? Yeah. Millennials are a great tailwind to this economy. I don't think we're going into this crazy recession, but from a pricing perspective on a lot of this stuff, yeah, we're going to come back down to earth.
Oh yeah, 100%. Yeah, the days of 20% year-over-year growth, it's not sustainable. We all knew that. Everyone called it. The average is 4 to 5% year-over-year in real estate, and it's going to probably come down to that mean, if not even lower for a period of time.